Welcome, everyone, to our 2002 Farm Tax Overview. My name is Mike Bandy. I'm a CPA in Richlands, Virginia, and in conjunction with Virginia Small Business Development Center, we are presenting this 2022 Farm Tax Overview for you. For the next 30 to 40 minutes, we're going to be talking about some changes that have occurred in the tax law as far as farms are concerned. We're also going to talk about basic bookkeeping and record keeping requirements and give you some suggestions to make your bookkeeping even more meaningful. We're also going to go over the Schedule F, which is the tax reporting document for farms that are owned by individuals, how that connects to your Form 1040 as well. So a lot to go over. Let's get started. The first thing we're going to see in what's new, let me drag myself over here so you can read what I have. There we go. You much rather see the information than me, I'm sure. There's a change in the standard mileage rate. Now, if you have a vehicle for business use, you're normally allowed to either take your actual expenses that you have incurred, like gas, repairs, tires, insurance, etc., or you can take so much per mile, a standard rate per mile that you can take in lieu of those expenses. So let's pretend like I traveled 10,000 miles for my business. Well, if my standard mileage rate is 58.5 cents per mile, as it is here from January through June of 2022, then my travel expense or my automobile expense would be the 10,000 miles times 58.5 cents per mile, or $5,850. It's interesting this year that standard mileage rate actually now has two components to it. Because of the increase in gas prices that we had in 2022, the federal government actually allows us to now take a certain mileage rate for the first 6 months and then a higher mileage rate for the second 6 months of the year. So as we see here, January through June of 2022, I can take 58.5 cents per mile traveled for business. Mileage for July through December of 2022 is 62.5 cents per mile. So we can see here it's going to be super important, as we'll see in our record keeping section here shortly, that we need to keep very good records to determine which rate applies. Do we apply the 58.5 cent per mile rate, or do we apply the 62.5 cent per mile rate? So those two things will make our record keeping even more important when it comes to mileage. Also notice we have an increase in our Section 179 expense. You can take, if you've bought this much, up to $1,080,000 of assets that you have purchased for your business if it doesn't cause you to have a loss. So if I bought a $50,000 tractor, for example, and I have enough profit to cover it, rather than depreciate that tractor over 5 to 7 years, which we'll see in depreciation later, I can expense the whole $50,000 of the tractor in the year that I purchase it. I got to be careful of a few things. Number one, that tractor must be used for business 51%. Second, if I do use a less than 100% rate, I can only take the business percentage of that asset value. So again, let's take the $50,000 tractor. Let's say I use it 75% for business. So if I have 75% of it, I can't take the full $50,000. I can only take a maximum of $37,500 because that represents the business portion of my asset. So we got to be aware of that. Also, if you have a vehicle, an SUV type vehicle, or a truck with a 6-foot bed or longer, or it has a gross vehicle weight rating of more than 6,000 pounds and less than 14,000 pounds. Instead of taking the $25,000 expense up front that I could take in previous years, now it's $27,000. So let's say I pay $40,000 for a truck for my farm and it's 100% farm use. Well, I got to be aware of a couple of things. Number one, I got to make sure it's 100% for farm use in order to even have the $40,000 considered. The second thing is, if I use it 100% for business, I can only take the first $27,000 as the total expense for the year, as long as it doesn't create a loss. Well, Mike, What happens to the other $13,000? That $13,000, the 40 minus the 27,000 that we are expensing is 13,000. We're able to depreciate that over the next 5 years. So you don't lose the additional $13,000 above and beyond the 27. All you simply do is take that extra amount and depreciate it over the next 5 years. So Section 179 is a very, very powerful tool that we can use in taking depreciation expense or asset expenditures off of our Schedule F. And when we talk about record keeping, I'm going to tell you about the documents you're going to have in order to prove how much you paid for the asset. Now, maximum net self-employment earnings. As a farmer, if you have profit on your farm, and you're supposed to have profit as a rule of thumb for 2 out of 5 years. So that shows profit motive. Okay. Now, as far as the profit motive is concerned, if I'm running it as a business and I have that profit in place, I have to pay 3 different types of tax. One is 2, actually. The self-employment part of it is your Social Security portion and your Medicare portion, which is basically 15.3% combined. You also pay federal income tax and state income tax on the profit as well. Now, it's not your gross income. Take your gross less your expenses gives you your net profit. That net profit will have self-employment tax, federal tax, and state tax calculated on it. If your net profit for your farm is $147,000 or less, you'll pay the 12.4% Social Security rate, which is one part of your self-employment tax, and you'll pay 2.9% of Medicare tax. If I add the 12.4 and the 2.9 together, that's my 15.3% self-employment tax. That's why I said it's 4, but it's really 3, because the self-employment portion is made up of your Social Security, and it's also made up of your Medicare portion. But if your net income for your farm goes above $147,000, then you don't pay the 12.4 Social Security percentage anymore. You only pay on the Medicare. That limit is actually increased by about $7,000 from the previous year. So we've had a major increase in how much is taxable, not only for the Social Security portion of our self-employment earnings, but if you have a W-2 job that you work in conjunction with your farm, that $147,000 is also your Social Security limit on your W-2. So it not only affects the farm, but it affects us personally as well. The special depreciation limit, in the previous few years, if you bought an asset and you didn't want to take Section 179, you wanted to take the special depreciation allowance instead, that depreciation allowance was 100% of the purchase price of the asset, and it could cause you to have a loss. Remember, Section 179 deals only with getting our business down to zero profit. And once it gets to zero profit, the Section 179 amount above that carries over to the next year. In this case, though, with special depreciation, I can take that depreciation amount and it can drive me into a loss in the current year. So I get more of a benefit from it on the federal part. The state can get a little hairy because the state and the federal, they tend not to like each other's rules. And the state tends to be about 1 year behind what the federal is. They call that fixed date conformity. So I may get that special depreciation allowance here for the federal, but the state may say, nah, you got to add it back, and we'll let you take it next year when we finally line back up with federal law. So special depreciation was 100% in previous years. Now it's reduced to 80%. Go back to our $50,000 tractor. If I decide to use special depreciation allowance on the tractor, 80% of $50,000 is $40,000. That's the amount of special depreciation I can take in the current year. The remaining $10,000 would then be depreciated over 5 to 7 years in the future. So I don't lose it, but I don't get to take the whole 100%. Also remember, the asset has to be bought new. I can't have used equipment qualify for special depreciation allowance. It can only be new equipment. It can't be used. One thing, if you look at me, this fits with me perfectly because meals are now 100% deductible. Used to, meals were only 50% deductible, but now if the food and beverages are provided by the restaurant, you can deduct them 100% as long as your meals have a business purpose. So that actually, it seems like not a lot, but man, you'd be surprised at how much that meals deduction can sneak up on you. With me, I probably need a few less meal deductions, but that's another presentation altogether. Let's talk about record keeping. Record keeping is so important. Good records help you file your tax return more easily and more accurately. One of my favorite stories, I had a client who was, let's just say, was a general contractor type business. And he brought in his records in a great big round Neapolitan ice cream bucket. And it wasn't totaled and it wasn't summarized. It was just a bunch of receipts. And they were, the bucket was full. You had to put the lid on it and just tamp it down. As I started to go through his records, I noticed things that were in the bucket that really didn't belong. Things like Belk receipts and so on and so forth. And like, as I'm going through this, it's taking me a lot of time to go through it. And then I had to end up summarizing everything that he had brought in. I said, Belk, really? He's like, well, I have to meet clients. I'm like, come on, man. You can't take that. You can't take clothing that's not uniforms. But the point is that he didn't know in his mind where to organize that particular transaction. So it would be something that we could ask or talk about while we were meeting. So by not having good records, it ends up creating, first off, a cost issue for you as the taxpayer, because either you got to pay me to do it, or you're going to get incorrect expenses reported because we don't have the total. And the second thing it does is it harms you from a management standpoint because you don't know exactly what all you've spent on what. So you can see records also help you see more clearly how your farm is doing during the current year. By having those categories, I can now see, okay, I paid this much for feed. I paid this much for vet bills. I paid this much to repair the fence. There's a hole in the fence. I had to repair the fence. Here's how much I earned during the year. And I can tell you what months I earned it, whether I made more in January, February, March, or maybe I made more in October, November, December. It allows me to see how I've done for the year. And if you collect year upon year upon year upon year, now I can do trend analysis. Now I can see, okay, how did I do this time last year compared to this year? Did I spend more for my utilities this year than I did last year? And if so, why? Did I spend more for feed? Well, what happened? Well, feed prices went up. Okay, that makes sense. But it allows you to look for hot points in your business that say, okay, why did this happen, and what do I need to do to address it? Those year-to-year trends also work this way. Once a business starts doing things in a rhythm, it starts becoming consistent. You'll notice that things tend to stay similar year to year. But if stuff suddenly drops off and then comes back again, what happened here? That looks like a hole. Something's missing. Maybe we had a transaction that happened last year that didn't happen this year. Maybe we forgot to pay something. Maybe we missed something. So those holes, or those changes in the patterns of your information, they can point you to things that are going on in your business so much faster than, well, I think I did that last year. I'm not for sure. Now you can go look. On your records, keep your day-to-day records for a minimum of 3 years. 5 years to me is preferable. The IRS says 3 years, which is perfectly fine. But 5 years gives me just a little bit more cushion in case I need to go back and see something. 10 years, 20 years, 30 years, at that point, you're collecting stuff and you don't really need it. Now, that doesn't apply to permanent records. Let's say that you have fixed assets or equipment. Fixed assets is an accounting term, but let's call it what they are. It's equipment, vehicles, fencing, things like that. Things that last longer than a year, that are helping your business to run. You want to keep proof that you've purchased those assets, that property, until you absolutely or actually sell the property. That's the thing. So if I have the invoice for a tractor that I still have in my farm, I want to keep it because I want to be able to prove that I purchased it. What if I've had the tractor for more than 5 years? Keep the invoice anyway. Let's keep proof that we purchased it in case we need to go back and prove that we bought it. Deeds on property are the same way. Whether it's a plot of land or a house or a farm or whatever it is, as long as you own that asset, let's make sure that we can go back and prove what we paid for it and when we bought it. And by doing that, it's keeping those permanent records until the asset is sold or until you remove it from use on the farm. Here. There we go. Now you can keep your records on paper or on computer. Either way is fine. I have people who are like, I don't want to use a computer. You don't have to. It can be easier if that's what you're used to. And if you want to use spreadsheets or use a program like QuickBooks, perfectly fine. If you want to take a sheet of paper and draw columns on it and write your transactions in those columns, all of my utilities are here, all of my repairs are here, all of my feed is here, all of my supplies are here, and then add them up at the end of the year, totally cool. Either way, you have organized and compartmentalized your information in such a way that it's useful to you. So I can't stress how important this record keeping is. The key is to keep them in such a way that you can easily summarize your income and expenses for the year by the category that you've created. Well, Mike, what categories do I use? We're going to talk about that. It's up to you as management and the owners of your farm as to how you keep it. But I would say that using categories that line up with your tax return is going to be beneficial. And we'll see that when we look at the Schedule F here in just a bit. To prove your mileage deductions, man, you got to keep a mileage log. You have to. The mileage log it can be a notebook, it can be on your cell phone, it can be wherever you want it to be, but it's got to show the date of the trip, the destination where you were going, the number of miles round trip that you traveled for this trip, and also the trip purpose. Why did you go? What was the business purpose for the trip? Keeping that mileage log is important. At the end of the year, I can total up those miles and find out how much qualifies for either the 58.5 cents from January through June or the 62.5 cents from July 1 through December. Also, if you're audited and they ask, well, let me see your mileage log, you can give them more than a blank stare. You can give them your records and you can verify and prove what mileage that you drove and how you arrived at your automobile expense. Assets purchased, again, keep track of the invoice to prove when you purchased the asset and how much you paid for it. The reason why that's important is we want to be able to prove what we paid so we can prove the depreciation that we've taken on the asset. Second, if there's cost remaining in it, as you depreciate it, the cost goes down, or how much you have available goes down. But we can prove how much cost it remains in the asset. So if we do sell it, we don't pay tax on gain that we didn't realize. The sales price minus the basis or the cost of the asset is your gain. Well, if I don't have proof of what I paid or have proof of what I paid less the depreciation I've already taken, I have to pay tax on the whole thing. So it's important from a tax standpoint to help yourself out by keeping track of the invoices. And also it helps us from a managerial standpoint to prove what we owned. Now, standard deduction versus itemized deductions. Okay, this is not exactly related to the farm portion of this presentation, but it is related to your personal income tax return. And remember, your farm is simply a part of your personal income tax return in most cases, unless you've incorporated your farm or you're in a partnership. So the law allows you to take the greater of the standard deduction or the total amount of itemized deductions you have. The standard deduction is just what the name says. It's standard. Everybody has the right to take the standard deduction. Well, I say everybody. I always remember in tax, any good tax answer starts with "it depends," and always and never tend to get you in trouble. So for the vast majority of us, the standard deduction is available to us in some form or fashion. The standard deduction for 2022, if you're single or married filing separately, that standard deduction is $12,950. If you're head of household, meaning that you are single, but you are maintaining as your household a household for someone that's considered to be your dependent, your standard deduction is $19,400. Finally, if you're married filing jointly, your standard deduction is $25,900. That's what you get off the top, even if you don't itemize. So it can go no less than that. Okay, unless you get to certain income levels that are in the stratosphere. But again, that's another story for another time. The key here is that the itemized deductions, if they're greater than your standard deduction, you can take the itemized deduction instead. And so itemized deductions include your medical expenses that are greater than 7.5% of your adjusted gross income. So if my adjusted gross income, which is my wages, my interest, my dividends, capital gains, and profit from my farm, if those are, let's say, $100,000, 7.5% of the $100,000 is $7,500. I can only count the medical expenses as part of my itemized that are above $7,500. If my total medical expenses for the year are $10,000, I subtract the $7,500 floor and come up with $2,500, then I'm allowed to count as part of my itemized. You can see it's kind of difficult to take medical expenses, but they are there. I can also take real estate, personal property, and state income taxes that I've paid throughout the year, limited to $10,000. That's the SALT limitation, or the state and local tax limitation. I can only take $10,000. If all of my real estate, personal property, and state income taxes that I paid outside of the farm, by the way, if I pay those taxes for the farm, I want to count that as an expense on my farm. But let's say I pay real estate taxes on my house, personal property on my car, state income taxes withheld from my W-2 or that I owe to the government. Those are limited to $10,000. So I have a limit on my medical of 7.5% of AGI. I have a limit on my state and local taxes of $10,000. You can see it's kind of difficult to itemize now. Home mortgage interest, if you pay mortgage interest on your house, that is deductible. Points are included. And I can also take charitable deductions off as well. So if my medical that I can take, my state and local income tax that I can take, my home mortgage interest, and my charitable contributions are above these standard deduction amounts, then I can take the itemized. If they're less than my standard deduction, I still get the standard deduction no matter what. So let's pretend like I add all of my itemized deductions up, I'm married, and my itemized deductions are $30,000. So my standard deduction here, according to the IRS, is $25,900. Well, if my itemized are 30, then instead of taking the standard deduction at $25,900, I can take the full $30,000 of the itemized. See? Now, let's pretend like instead of $30,000, my itemized deductions are $20,000. Well, that's obviously less than the $25,900 that I would get if I do standard deduction. So I would take the standard because it's higher. So I get the higher of the two. And that's how itemized deductions and standard deductions work. Do these affect your farm? And the answer is no. Standard deduction and itemized deductions are not part of your farm income. Okay, this is something that we calculate after we take a look at the farm. Government and other monies received. Okay, if you receive any kind of CFAP payments, feed and assistance payments, crop insurance proceeds, income from cooperatives, patronage dividends, anything like that, and it's more than $600, you're going to get the appropriate 1099 from the government agency that paid you those monies. And if you get a 1099, well, you're supposed to report the income whether you get the 1099 or not. But if you get the 1099, you got to make sure and let your tax preparer know, hey, got this. Now, you may have already included that amount in your records. Remember our record keeping from a few slides back? If you've recorded that, then that's all well and good. We don't count it again because you got the 1099. We say, oh, we've addressed that. It's here in our receipts. But it is important to let your tax preparer know, hey, I received these 1099s. All of these items that are listed on this slide, CFAP, crop insurance, co-ops, and patronage dividends, should be recorded, must be included in income on your Schedule F. Now, conservation expenses through NRCS, okay? Natural Resources Conservation Service can approve a plan for you if you've gone through this process that it helps you to deduct certain expenses for soil or water conservation, prevention of land erosion, or where the land is used in farming, or endangered species recovery. Okay, if there's a plan through NRCS that's been approved by it, or if it's a conservation plan of a comparable state agency, and your expenses are consistent with that, then we can take these conservation expenses on our Schedule F. Trick is the deduction is limited to 25% of your gross farming income. Let's say that your gross farming income is $4,000. Let's just say, let's use an easy number because as I get older, it takes my math a little bit. So if my gross income is $4,000, 25% of that is $1,000. Well, if my conservation, soil or water conservation expenses are $3,000, I'm limited to $1,000 because that is 25% of my gross income. So I take the $1,000 on my Schedule F as an expense, and the other $2,000 carry forward to the next year. So I don't lose them. I just don't get to take them as soon as I pay them. Now, let's go a little further. Let's say that my gross farming income is $20,000. 25% of $20,000 would be $5,000. My conservation expenses were $3,000 because the $3,000 is less than the 25% of my gross farm income of $5,000. I can take the entire $3,000 in full. So it really does depend on what your gross income is on your farm. You must keep a copy of the plan with your books and records, just like with everything else. You see the thread going throughout this whole thing is record keeping. Keep a copy of the plan with your books and records to support your deductions. Now let's talk about depreciation versus Section 179. Most farm personal property, vehicles, equipment, fencing, computers, whatever you use, that's not real property, it's not land, is depreciated for 5 to 7 years. And that includes equipment, breeding stock, and fencing. Farm structures like buildings and sheds, though, are depreciable over 20 years. I don't get the full amount in the year that I buy it. I've got to wait 20 years and take a little bit at a time each year. Okay. Section 179 or special depreciation, or the 80% we talked about, can be taken on personal property with a class life of 15 years or less. Special depreciation, again, is limited to 80%. Asset purchase must be personal property and must be new and not used. I have the right to take either the Section 179 if I want a quicker expense or a greater expense for the current year, or I can depreciate it anywhere from 3 years on software to 5 to 7 years on breeding stock, on equipment. 15 years I can take for land improvements like putting in wells or creating roads. 20 years for buildings and sheds. So I have several different categories, and I can depreciate it over the life of the asset, and that's no problem. But I can also look at Section 179 of the special depreciation allowance on 15-year property that's personal property. So again, that's going to be things that are not land, not like land improvements or even a well, I would argue. But if I'm looking at things like tractors and equipment and breeding stock and things like that, then that's eligible for 179 or for special depreciation, depending on whether the asset is new or used. Now, what if I repair something? Okay. Unlike capital expenditures, assets, repairs are completely deductible in the year that they're paid. Determining what's capital and what is repair is the key here. Okay. If I make a payment to bring something back to where it was before it broke, before it tore up, that's a repair. If I have a hole in my fence, I've got to repair the hole in my fence or my cattle are going to get out. If I don't repair the hole, then I'm in deep trouble. Repairing the hole only takes the fence back to where it was before the hole happened. That's a repair. Okay. But let's say I replace the fence entirely. At that point, I've put in something that is new and is going to have a substantially longer life than what remained on what I had before. And so that is going to be a capital expense. It means I've either got to do Section 179, special depreciation, or regular depreciation. The key is it putting it back to where it was before it tore up, or in the capital case, am I making it far better than what it was when I first went from the condition it was in right before I replaced it, or am I building something that I haven't put in place yet? If it's made to substantially improve, create, or purchase an asset, those are capitalized and depreciated over the useful life of the asset. Business expenses for home and home office expenses. So the rule of thumb, it's been beeping here for a while. There we go. So the rule of thumb is any money that you spend to help you make money is potentially deductible. People ask me all the time, well, Mike, is that deductible? Well, again, any good tax answer, it depends. But I want you to look at it through the lens of, is it helping me make money? By me spending this, is it helping me either make money by being able to sell my cattle, or is it helping me grow my cattle, whether it's feed or supplies or veterinary medicines, things like that? Or is it helping my infrastructure in terms of repairs? Anything that you spend that helps you make money is potentially deductible. Examples are feed, fertilizer, vet expenses, repairs, insurance, supplies, taxes, things like that. I have to pay those, or my business doesn't run. So I go back and I talked about my ice cream bucket guy. He had the right idea in that in his mind, he was wanting to see, we could go up together, is this deductible? And always feel free to call your tax preparers, you're spending money, and say, hey, is this deductible or not? But also he did look at it at the lens of, well, I kind of need this in order for my business to run. I would rather have you tell me something that you think's deductible and it not be, than you not tell me something that's deductible and it is, because we don't want to leave deductions laying on the table. Now, home office. You hear a lot of people talk about home office. The IRS has a safe harbor home office expense of $5 per square foot up to 300 square feet. Now, if the room is exclusively for farm use, and that includes office work as well, then you can consider taking this home office. It can't be a room in a house where you occasionally do farm work. It has to be dedicated for this purpose only. A lot of times, even a separate structure qualifies just even more easily. But if it's a room in your house that this is the farm room, this is where we take care of the farm, then I can take $5 per square foot up to 300 square feet for a total of $1,500 that I can take as a safe harbor home office expense. Well, Mike, what does the safe harbor home office expense have to do with anything? Well, you could also choose to claim a portion of your expenses, your utilities, interest, taxes, based on your invoices and your expenses that you paid for your house and the square footage of your house. Now, the IRS says if you just claim the safe harbor of $5 per square foot, we're not going to argue with you. We are looking to see if it's legit, a home office, but we're not going to go and tear into your utilities, expenses, so on and so forth. We're going to give you $5 per square foot. If you go under the actual part, then you've got to go prove all of your expenses on this amount, on top of proving that this was used as your home office. So back in the day of black and white TV and horse-drawn carriages, when I was a kid, that home office was a red flag. Come see me. But now with the safe harbor, it's a lot more accessible to many more people, and it's not as difficult an expense to either take or to prove. Let you take a look here at the Schedule F. Let me put me right there. There we go. The Schedule F is I want you to see it for a second, because this is part of your tax return, okay? But it is not your whole tax return. If you look at the different components of it here, we can see at the top of it, it's the name of the farm, the proprietor, which is generally going to be you, your social security number, what type of farming you do. Oops, went the wrong way. A second here. There we go. Basically, your identification information. Did you materially participate in the farm? we want to materially participate in farm because that allows us to take our expenses below our profit or actually create a loss if we materially participate. But notice in section 1, remember we talked about the income that we have to count. Here, sales of purchased livestock or other resale items and the cost of that livestock. So there, if I bought it for $20,000 and sold it for $30,000, then I made $10,000 in gross profit. That's on things that I bought and then I later sold. Here, line 2, sale of livestock, produce, and grains that you raised. Well, let's say that our cows had calves and we raised those calves and then we sold those calves. The costs that we take on those calves are going to be here on the expenses. We didn't pay anything for those calves up front. We paid maintenance and we helped them grow, but we didn't pay anything up front for that calf. So in that case, we would report that as sale of livestock that we've raised. Notice under here, co-op distributions, that's on Form 1099 PATR. Those are also patronage dividends as well. Agricultural program payments, those are listed here. Commodity Credit Corporation payments, those are listed here. Crop insurance proceeds, all those things we talked about a few slides back, that if you got more than $600 from it, that you get a 1099. Hey, that's where they're going to show up. They're going to show up, watch this, I'm still getting my pointer down. They're going to show up right there. They even drag me over here. Let's drag me over here so I can talk about. Here we go. So here we're at the end, we are in, right there, we are in the income portion of it, okay? And so when I total up all of these income items from here all the way down, when I get to line 9, it's going to say that's my gross income for my farm. Remember, we talked about conservation expenses that are allowed up to 25% of your gross income. There is your gross income. That's line 9. So that's going to take into account the sale of my livestock that I've purchased, sale of the livestock that I've raised, any kind of government payments that I've received, any kind of other income that I received. All that is going to go and be totaled up and show in line 9. Okay. Now let's move down here to our expenses. Remember, expenses are any monies that you pay for the business that help you create business, that help your business out. Notice the things that we see here. Car and truck expenses. Remember our mileage rates from earlier? That shows up in line 10. If you do the actual, if you keep track of the receipts and say, I'm going to take the tires, the insurance, the gas, so on and so forth, that will go there. But you can't use them both. I can either use standard mileage or I can use actual. Remember that. I have chemicals here, conservation expenses. I have fertilizer and lime, insurance. Second here. Insurance, I have interest. I also have things like repairs and maintenance. Remember, we talked about what's a repair versus what's capital expenditures. Supplies, taxes, utilities, all these expenses are going to be listed here under Part 2. So under Part 2, we can see all of this from line 10 all the way through line 32 represent our expenses. Now, line 32, A through F, if there are expenses here that are not listed in lines 10 through 31, we'll list them in line 32. In the end, when we add all this together, what we'll see down here is that our total expenses are on line 33. Total expenses. And we take those total expenses away from our gross income to get line 34, which is our net farm profit or loss. That then carries over to your Form 1040. I just want to show you that for a second. Let's go off script here just for a second. These forms, if you ever want to take a look at them, you can go to the IRS website, www.irs.gov. We can go here, okay? And we can go searching for forms. Watch this, okay? We can find forms and instructions. First off, what I want to show you is Schedule F. At this point, hey, look here. There it is. Right there from the IRS website. You can see it right there. It's even a little bit bigger here than what I have on my slides. But you can see here, hey, there's our gross income, right? There's our total expenses. And there's our net profit from the farm, right? Now, where does that go? Well, I'm glad you asked that question, because what we're going to do is look and see that it actually goes to Form 1040. So watch this. We're going to go to Find Forms and Instructions. We're going to talk about form. Actually, it's going to be Schedule 1. I want to show you something here first. I want to connect it. Okay. And if I looked at Schedule 1 here, notice we're looking at rental real estate. Line 6, farm income or loss, attached Schedule F. So remember this Schedule F right here, this income on line 34 connects to your Schedule 1, line 6. Well, where would that go? Well, we combine these lines and it goes here on Form 1040, line 8. So watch this. If I go here and look at Form 1040, line 8, and I want to pull this up for you one more time from the IRS website. Right here we go. Now, they still had the 2021 forms up as of the date that I did this. So please forgive me. We don't have 2022 just yet, but it's not going to change a whole lot. It's going to look very familiar. Okay. So remember, it says to put it on line 8. Okay. Let's look here. Line 8, other income from Schedule 1. And that ultimately is where your farm income is going to go. Notice also, here we have our standard deduction or itemized deductions on line 12A. So see how they're starting to come together. We have our farm reported on Schedule F. We take away our standard deduction, and this ends up giving us our taxable income, and that's what we're going to pay income tax on. Okay, so that's the deal there. That's how it works. So I know it's a little bit of we went a little off path there, but I just wanted you to see, hey, listen, this is what the flow of it looks like. Okay. Now, if you have any questions, feel free to contact me at my office. We'll be perfectly glad, or even better, feel free to call our friends at the Virginia SBDC, the Virginia Small Business Development Center. They help all kinds of businesses with all kinds of issues as far as getting them set up, giving them advice on how to do things, making sure they're on the right track, and those resources are free. So please feel free to use that resource. It is available to you. And if you have any questions, please let us know. Just remember, key points here. Keep track of your records as best as you can, and always think about, is what I'm spending going to help me in my business? If it is, I need to let somebody know. Thank you guys for your time today. I appreciate your patience. And again, if you have any questions, let me know. Otherwise, God bless. You guys take care. Thanks.